Welcome, dear traders, and hello to everyone who is ready to start the week with a fresh review of the US stock market. In this video, we will talk about the key events on Wall Street. The close of the previous week was very pessimistic and full of losses. Galloping inflation has revived fears in the market, which triggered a massive sell-off in the risk assets. The leading US stock indexes slipped deep into negative territory by the end of the session. The Dow Jones fell by 2.7%, the NASDAQ plunged by 3.5%, while the S&P 500 index lost 2.9% to trade at 3,900 points. Judging by pre-market trading, the market sentiment is moderately low today. The stock leaders were losing ground at the rate of 1.8 and 2.79%, while the shares of some big tech companies were declining at the pace of 4%. As you can see, Monday promises to be another losing day for the US stocks, as the sell-off wave is likely to continue. The trading range for S&P is seen between 3,650 points and 3,840 points. On a Friday, major stock indexes posted losses. Among them, NASDAQ suffered the most. By the end of the weekly session, it lost 5.6%. And this year, the tech index has already depreciated by 28%. Today, the S&P 500 index is also on the edge of the bear market. Since the start of the year, it has slipped by 19%. The sell-off in the stock market came after the US CPI data showed that inflation in May has reached its highest level of 8.6% over the past 41 years. This reading exceeded the forecast. The fresh data intensified fears of the looming recession and confirmed the aggressive stance of the US Federal Reserve. Some large banks and hedge funds have already said that it's time to brace for an extended bearish rally in the risk assets. Economists compare the current situation with the market crash in 2008 and give gloomy predictions. Besides, experts assure that the US regulator will act more aggressively due to the recent data on inflation. So, the rate hike of 75 basis points at this or next meetings seems very likely now. There is a there is a 25% chance that the Fed will take this step as soon as this week. It's natural that investors prefer to avoid risk when the macroeconomic data is downbeat and inflation shows no signs of a slowdown. Besides, recent tests in China indicated another possible wave of COVID-19, which may bring more lockdowns and more disruption to supply chains. At the start of the pre-market trading, Apple, Alphabet, Microsoft, Amazon and Tesla dropped by more than 4%. Analysts assured that with the start of the US trade, the pace of a decline may considerably accelerate. Meanwhile, the published data on the US inflation pushed the US dollar index to the level of 104.63. The US dollar has developed an upside dynamic today and is rising at the pace of 0.43%. It seems that the greenback is heading for the 20-year high of 105.01 that was last seen in May. It has a good chance of setting a new record in the near term. In the coming hours, the US dollar index will stay in the range between 104.20 and 105.20. This week, the market will focus on the efforts of the world's central banks to tame persistent inflation. On a Tuesday, the two-day FOMC meeting will begin, and the regulator is expected to announce a 50 basis point rate hike on a Wednesday. Likewise, the Bank of England intends to raise the interest rate. Meanwhile, the Swiss National Bank is preparing for a tightening cycle. The Bank of Japan continues its dovish rhetoric in spite of a tumbling yen. On a Monday, the currency hit the 24-year low versus the dollar, and the euro, the pound, and the Swiss franc nosedived to the 4-week low against the dollar. The 2-year bond yield spiked to the level of 3.241% unseen since 2007, and then faltered to 3.204%. The 10-year bond yield rose by 7.2 basis points to 3.235% at the high of 2011. The loonie strengthened amid a sharp increase in the dollar. Today, USD CAD trades at 1.2845, heading to the May high of 1.30. However, quotes are unlikely to hit the mark intraday. The pair is seen moving within the range of 1.2800 and 1.2960. The loonie, like other currencies, is still under the influence of the stronger dollar and may stay this way throughout the week. Meanwhile, commodity prices that traditionally provide support for the Canadian dollar bounced off their highs today. Crude, which has soared by more than 50% this year, went down, with the Brent dropping by 1.52% to $120.17 per barrel, and WTI falling by 1.65% to $118.70 per barrel. On a Monday, Bitcoin plummeted to the 18-month low and traded at $23,630, down by around 20% from Friday. Other tokens, including Ethereum, Cardano, Solana, and Dogecoin, also tumbled. Ether lost about 15.8% and traded at the $1,234 low, unseen in a year. Meanwhile, Cardano and Solana plunged by 13% and 16% respectively, and the value of the crypto market on Monday fell below $1 trillion for the first time since January 2021, reaching just $926 billion, according to CoinMarketCap. As a reminder, the crypto market peaked at $2.9 trillion in November 2021, and cryptos came under additional pressure as Celsius, one of the world's leading crypto lending platforms, announced it had paused all transactions and withdrawals across its network due to extreme market conditions. As the result, Bitcoin broke through support. In the short term, the coin may slide to $17,000. As for the daily forecast, digital gold is likely to trade within the $18,900 and $24,000 range. And this is how our analysts view the beginning of the new trading week. The market is likely to stay volatile before the outcome of the FOMC meeting. And that's all for today. See you in our next news release.